Hello, everyone. Thank you for joining us today for the financial advisory session for teachers. I'm conscious some of you may be listening to this on playback, but it's lovely and sunny down in Cork at the moment, which is where our offices are based. So I'm going to spend the next kind of 15 minutes or so just running through a few takeaways. I'm joined today by two of my colleagues, Cliona O'Donoghue, who's our Business Development Director, and also Keenan Cunningham, who is our Head of Marketing and Business Development. So just to run through, and please do feel free to put any questions on the session. I'm just going to kick off a poll there, just waiting for one or two people just to join. And I do appreciate, obviously, you taking the time, as I said. So hopefully you can see the poll come up there. It's just, I suppose, for you to complete, just to answer the question as to which of the areas of financial planning are most important to you. And I can see a few of you are starting to do that. And as I said, if you would like to, would really like to encourage you to put any questions into the Q&A section today. Cliona's going to be joining me shortly to go through some of the questions that we've received over the last 2 weeks. And we really want to make this as interactive and as meaningful as possible. So just to start, for those of you that are not familiar with us, Alpha Wealth are a financial services company based in Cork. We do have a small presence in Dublin. And there's currently 8 qualified professionals who provide financial advice to teachers. We do with POA workers of all descriptions. And it's really about trying to help people make their money work harder for them. You can see myself and some of the guys in the team on a recent kind of photo shoot we did there in the Radisson Hotel in Cork. So just to get into the kind of the crux of the discussion today, I want to leave you with kind of 5 takeaways. And basically, they're broken up into trying to make sure that you are planning effectively for later years. I don't like using the word pension. And really, the key thing I always say to people is it's about when are you looking to try and get to a point of financial independence? And I know you might say that's a play on words, but you'll get the understanding of that as I go into this. Obviously, a lot of you may be paying tax at the higher rate. And one of the key, I suppose, areas for us as financial advisors is to help our clients reduce the tax they pay. And there is another option outside of a pension I'm going to touch on today as an opportunity for you to do that. We've had a few queries from people who are looking to get onto the mortgage ladder and who have mortgages. And I'm going to talk briefly about how I believe that you can reduce the term of your mortgage and basically pay a lot less. For those of you that have children or indeed are looking to save, whether it be for a property, for a car, and indeed for medium to longer term savings, there is a vehicle that I'd like to talk to you about. I think is an absolutely no-brainer in terms of an opportunity outside of the banks. And then lastly, looking at protecting your income. So as I say, there's many different areas of which we as individuals need to plan for. And I suppose a lot of us are very busy in our day-to-day lives that we don't always, I suppose, place as much emphasis on this as we should. And what I would say is that realistically, for me, the most important thing is to pick a financial advisor that you can trust in, that can provide you with the professional advice that you need, because everyone's situation is different. We all have different, I suppose, areas that we need to focus on. And really, financial planning is about balance. I come across a lot of people who have a good sense of what they should be doing. And sometimes it's just a case of checking in with a financial advisor to make sure that you are doing the best that you possibly can. And I'm going to touch on that as I go through this. So the first takeaway, retirement planning. Many of you are members of obviously a public service scheme, and it's, I suppose, firstly, important to try and get a better sense of what your pension may be worth or look like, as I said, when you are looking to draw it down, whether it be at age 60, 65, 55, or whenever. And this is where we work with teachers in terms of trying to build out this roadmap. And this applies to partners and spouses as well, of course. I always say to clients that sometimes if you're in a relationship, you can't just focus on yourself as an individual. And it's worthwhile perhaps considering taking the opportunity for a complimentary review that we're offering. to have a discussion and maybe involve your partner as to how you can best manage your finances as a collective. But just to focus on the pension principle, and I'm using an example there on the screen, that you've got an opportunity to pay what are called additional voluntary contributions into your pension. Now, we can help you as a teacher get a better sense of what your pension looks like. And depending on when you became a teacher, you'll have slightly different rules associated with the type of pension scheme that you have. But again, you know, we assist teachers, we can get that information on your behalf. And more importantly is that then we can advise you completely independently, because we have no bias as to how you can navigate your pension scheme. But the key principle about pensions is that if you think about your money, by making a contribution into your pension of say €1,000 from your salary, you will get a deduction back from the taxman if you're earning over 36,800 of €400 on that payment. That's a 66% return by at the time that you make that payment. To get €600 and turn it into 1,000, that's the return on investment that you need to achieve. The other advantages of putting money into AVCs is that your money grows tax-free whilst it's in a pension. Now, some people think that they're going to suffer tax at the end, so it's not really an advantage. But I assure you it is. And Einstein spoke about this effect of compounding as being a powerful force. If you're in your 30s, 40s, and indeed 50s, the effect of the returns over the years is going to be enormous. And the fact of the matter is that when you do draw down this benefit, and it could be from 50 years of age onwards, you're entitled to take 25% of the fund tax-free, so you're not paying tax on the full amount. I want to move on just on the second takeaway, and as I said to you, I want to try and encourage you to ask any questions, so please do feel free to put any questions into the Q&A, and you can do it anonymously if you would like to. But there is a scheme that some of you may not be familiar with. It's called the Employment Investment Incentive Scheme. And it allows high rate taxpayers, so anyone who's earning typically over, say, 45,000 a year or more, to make an investment into an Irish company. And there's about 70 companies or so a year that apply for this type of scheme. And it's a revenue approved scheme, as I say, where the government will give you back 40% of your investment capital a year after you make that investment. So for someone who's invested into the scheme in April of 2022, by the April of 2023, the revenue would have given you back 40%. It's a really useful scheme. I would encourage you to at least educate yourselves. And to give you a kind of a very quick working example, let's say that you had €10,000 sitting in the bank today, and you had no requirement for that money for at least 4 years. This scheme is a 4-year scheme, and basically what it does is it allows you to invest that money, get 40% back from the revenue, as I said, within 12 months. And at the end of the 4-year period, you look to get your investment back plus a return of about 20%. So again, if you think about it, that's a 6,000 net investment in order to return back 12,000 to you. Fantastic return of monies. Some of you may be wondering, is there risk in this? And yes, there is. There is no way in which anybody can say to you that you can get that sort of return without taking any risk. And the risk is that the company that you give this money to for 4 years does not pay you back. This is our role as qualified advisors, to find the best companies in Ireland and present them to you. And we provide full information. We're not biased, and we explain to you the workings of the scheme. The reason why Revenue provide this, by the way, is that it is helping companies grow in Ireland, but they don't necessarily need to be startups. Some of the companies that we are advising clients to look at this year have been in operation for 6 or 7 years, and they are doing extremely well, and they've benefited from COVID, which is why we're recommending them to our clients. The third takeaway, I'd like to talk about mortgages and getting on the property ladder, or maybe looking to move properties. And we've had a number of questions which Cliona will, I suppose, deal with slightly later. But the key thing I'd say to you all is consider what rate of interest that you are paying on your mortgage, if you have one currently, or indeed if you're looking to get a mortgage. And my advice would be to speak to a mortgage advisor who can shop around for you. I struggle to understand why sometimes people deal directly with a specific bank. A mortgage advisor is like going into all the banks together at the same time. And the key question I always say to people is, are you on a rate of 1.95%? Because that's the best rate that's available in Ireland. ICS will offer that to you as a teacher, and also Avant have offered that with those people who have a good loan to value ratio. And if you have a mortgage with another institution, particularly KBC or Ulster Bank, and obviously they're leaving the Irish market, it's worth just exploring what your options are. A lot of people think that they can't do anything and that they're forced to move to the institution that the bank placed them with, which will be Bank of Ireland or Permanent TSB. That is not necessarily the case. We ask people to do very little. The way in which we work with our clients is we say to them that we can get information on any plans that you have. You may have purchased income protection from the likes of Corn Market, for example. You may currently be doing AVCs, or you may have mortgage protection already. And we say to you that if you'll allow us, we reach out to the product providers, get the information, present it to you, and then we are able to give you more informed information around the cost that you pay. But if you contact your bank, it's the only thing that I would ask our clients to do, and find out what the cost of breaking your fixed rate mortgage is. Indeed, if you are on a fixed rate, you might be surprised that rate could be as little as 0. It will then give you the ability to maybe fix with your bank, and our advice would be to fix for a long term, because rates are likely to increase, even if with your likes of KBC or Bank of Ulster Bank. So, for example, anyone who's with Ulster Bank at the moment, even though your mortgage will move across and you won't be affected now, when you move over to the new institution, which looks like it's going to be Bank of Ireland for you, the fact of the matter is that you're going to find yourself in a more expensive institution when rates are increasing, which is not going to be ideal. Again, we can help you with this, and I would ask all of you to maybe reach back to us in terms of getting some more information. And by the way, we do not provide mortgages in Alpha Wealth, so we do remain completely independent, and we're not charging teachers for any advice that we give you, either initial or any subsequent reviews. Some of you may be wondering how we are rewarded, and it's typically through any products that people may buy from us. But we're not looking to do a sales pitch today. We're looking to try and educate and help you get the best product that you can. If it happens to be with Alpha Wealth, all well and good. Mortgage protection is another area. Again, a lot of you who have mortgages will have been forced to take out mortgage protection, and generally speaking, probably with a mortgage broker or the bank that you're dealing with, and it tends to be a very lucrative product. A lot of the banks are tied agents. AIB are tied to Irish Life. Bank of Ireland are tied to New Ireland. I know when I worked in AIB for 9 years, we did not shop around, and certainly we weren't the most competitive, but we had a captive audience. And even at this stage, even if you had a mortgage for 9 years, it is well worth your while checking what you're paying for your mortgage protection. Anybody that's paying over 25 euros a month, in my opinion, is paying too much. Another area is house insurance, which again is a product that you would have been forced to buy. We broker that for our clients. We find O'Leary's in Cork to be the most competitive, and we just provide you with the contact details of someone who's very good there. And again, if anyone has a house insurance renewal coming up over the next 6 or so months, please do reach out to us, and we'd be happy to provide you with their details. I'm not going to spend too long on this, but there's a little bit of, I suppose, navigating around mortgages. You know, obviously a lot of the banks have introduced green mortgages, and anyone who has a mortgage and has an energy efficient house, i.e. if you have a BER rating of B3 or higher, it is certainly an area that I would look to explore, because you can get yourself on a much lower rate over a fairly long period of time. So again, these are things just to watch out for. Quick example, Joe and Mary Bloggs, 35 years of age with a 300,000 mortgage. I met these clients actually a few weeks ago. Now I've changed the names obviously, but they were on 2.95% with AIB. And by contacting AIB, and they found out that the cost of breaking their fixed rate was 200 euros, they were able then to very easily change down to a rate of 2.2%, which was reducing their monthly repayment by over 120 euros a month, which was 42,000 of a saving over the lifetime of their mortgage. It's immense. I mean, if you think about what you could do with that money, how many holidays it will afford you, it's well worth making that one phone call. So finally, I'm just going to talk very briefly about getting your money working harder. And as I'm sure you're all aware, the banks, post office and credit unions are not paying interest at the moment. And the key thing I say to everyone is, if you're looking to save over a period of 3-4 years or longer, you shouldn't really be saving in the banks. They're available to us for short-term needs. If someone is saving to pay a tax bill at the end of the year, you are restricted to only dealing with the bank. If you have any commitment to monies, let's say for a holiday next year, again, you're restricted. But if you're saving over a 3 to 5 year period, or indeed if you're saving in for your children over a 10, 15-year period, these banks do not operate well for you, because you're going to lose money due to inflation. And there are some very good options available within the insurance companies. This is an example of one where Zurich, who are one of our preferred providers, offer a really great plan. We can send you some information on this. I have it myself, and I speak to anybody that has the ability to save over 3 years or longer to consider. We offer it to individuals at a very low fee, and anyone who has this plan already, whether it be with Irish Life, Zurich, Aviva, or whoever, I would ask you to consider the fees you're paying. You know, you may have the right vehicle, but you may be paying too much for it. And this is where it comes back to having the review. But these plans can generate returns of 5, 6, 7% or more per annum, and they consistently would do that. But the key consideration is that you need to have 3, 4+ years in order to get the growth from them. Just showing you an example here on the screen of someone who's saving the child allowance. And then you can see here, and people often ask me, like, how much do you need to save? And I say to them, if you do it early, the child allowance should suffice. I have 4 children myself, and you can see that, you know, if I was able to put the 140 a month away for each child, by the time they reach 18, they'd have a fund of about 42,000 euros. Now, inflation will erode about a third of that, but I still believe it's a really good starting point for any parent to look to achieve without having to commit a lot more money to. Those figures, by the way, do allow for a 4% growth rate. And this is why the banks do not serve you well, because you're not going to achieve that with them. And the Zurich savings plan that I referred to, what I really like about it is that it's flexible. You can change the contributions at any stage, you can stop them. But more importantly is that you can withdraw the money without penalty, which is really powerful, because if interest rates do start to rise, you'll have the ability to draw that down. I'm not going to talk too much about risk and reward, but the key thing I would say to you all, and again, one of the major takeaways is it doesn't matter how conservative or how risk averse you are. What you need to consider is what length of time that you're saving for. So if you're a teacher who's aged 30 years of age and you're paying into ABCs, you should be taking risk with those ABCs categorically. I don't care how conservative you are as an individual. And the reason for that is that you've typically got 20 or 30 years for that money to grow. And it's going to be a massive missed opportunity if you're not doing that. And funds over a 5 to 10 year plus period will always outperform cash. It's proven historically since the beginning of the time. And I would say to you, it's worthwhile just exploring that for yourself, or looking at us as an independent advisor to help you. This is just to finish off on the projections showing you what 100 and 500 euros a month can achieve at these conservative growth rates of 4% over a 10-year period. And it's a really good opportunity for all of us to look at our savings and just explore other alternatives to the banks. The final thing I just want to talk to you about is income protection. I know a lot of you obviously have income protection through your employment. Typically, it tends to be 3 months full pay, 3 months half. And the likes of Core Market would generally deal with teachers. And a lot of teachers think that they're tied to dealing with Core Market. And the key thing is that you're not. But more importantly is that it's worth assessing independently whether you have the right type of cover and when do you indeed need it. Some teachers, for example, may have taken income protection when they were working full-time, and perhaps because of the fact that they may be working part-time now, that they haven't adjusted the income protection, because it won't pay out any more than 3/4 of your salary at the time that you draw this down. So really what I'm trying to suggest here is that it's certainly an area to consider. And like everything, it's worth looking at what the cost is versus the benefit. But the most important thing is not to say, oh, well, I have it. It's about whether it's still appropriate. And things change over time. You know, some of you may have children since, some of you may have taken part-time work, some of your incomes may have increased, and indeed some have may reduce. So really, the key major, I suppose, message that I want to leave you with is that make sure that you check in with someone at least once a year. And if you have a financial advisor, absolutely work away with them. But if you haven't, it's worth exploring just in terms of seeing if you are on the right track. So I'm just going to move forward just in terms of how income protection benefits individuals, and just making sure that you are covered, obviously, after your pay reduces. But again, like that, it's not something that I'm saying to you, you know, it's a massive concern to, and it's about, again, as I said earlier, about balance. So addressing other needs, perhaps like your pension, like life assurance in terms of, are you correctly insured, and making sure that you do have the right balance. So I'd like to now bring in my colleague, Clean O'Donoghue, who's going to basically go through a few of the questions that we received during the week. And then for anyone who would like to ask, obviously, please feel free to put any questions into the chat function or the Q&A. I've seen that one person has already done so, so thank you for doing that.
Great. Well, I think we'll just start off with one around pensions. So how do I know what my pension is worth?
So again, really the best way to do that is to get an advisor such as ourselves to apply for the information for you. It can be quite difficult to get factual information, and it does take a time. And we have some very good people working in Alpha Wealth who will, you know, I suppose, be like a dog with a bone and provide that information for you. So as I say, that's the shortest and simplest answer to that question.
Okay. And then in relation, I know you mentioned around AVCs. So should I be paying into AVCs? And then we can move on to the next question, which is linked as well.
Generally speaking, without looking at the specifics, and it's important just to assess, obviously, your overall financial position, you know, in terms of like, do you have loans, and what is the consideration towards other areas? But the short answer typically is yes. And the main reason for doing so is that it's going to allow you to work less years. So if anyone has any desire to retire earlier, in my opinion, they should be looking to pay money into AVCs.
And then I suppose you've mentioned retirement there, Nick. Can you draw down on your AVC before retirement?
No is the answer to that. You have to draw the AVC at the same time that you retire from your main employment.
Okay. I'm 50 and on the old D stamps. Can I up my credits to get a state contribution pension?
That's a good question. Yes, I believe it's possible. We're not tax advisors, but if you'd like to maybe message me directly, I'd certainly be able to get you more information on that and get that clarified for you.
Okay, and then the next question is, I have 2 children, so I'm receiving children's allowance for 2 children on a monthly basis. What is the best savings option for this money each month?
If your children are younger than the age of 15, which I'm not sure did that information
actually they said their children are 3 and 5.
So on that basis, the Zurich savings plan that I mentioned earlier, in my opinion, absolutely 100% is worth exploring. We would offer that account on a very low fee basis. It's provided by most good independent financial advisors around the country, so you don't have to take my word for it. But the cost of anyone who sets up that plan through Alpha Wealth is a management charge of 1.6% per annum. There are no entry or exit fees. A lot of financial brokers will charge at least 2 or 3% to enter the plan. And there is a government levy that we would cover for all teachers, which wouldn't be covered by most financial brokers. But that would be absolutely the plan to consider.
And I suppose just on that, Nick, I mean, can people go directly to Zurich or?
No, because Zurich are a broker-only company, so they want to do business with financial brokers. They see us as packaging cases better for them, and obviously we provide volume. But like most, I suppose, intermediaries or you know, insurance agents that you may have dealt with, it's actually a win-win. By virtue of the level of business that we provide Zurich, we can get lower fees than we could if you were able to go to them directly.
Is 140 per month a minimum for child savings? So I suppose the question is, like, what is the minimum that you can put in to set up this child savings plan?
For the Zurich savings plan, the minimum contribution level is €100 a month, and you can put lump sum payments into it as well. So some people may have a lump sum of money, but they may not be in position to save monthly, or they may want to do both. But the answer to that question is €100 a month.
Okay. What should I do to reduce my mortgage costs?
So as I mentioned earlier, the main way that you can reduce your mortgage costs is to reduce the interest rate. I come across a lot of teachers that give me information about how much they are paying towards a mortgage every month, 800, 900, 1200 euros a month. It doesn't help me help them. The question I always will ask is, what is the rate of interest? And just remember, realistically, you should be looking at a rate of close to 2%. Now, obviously, again, there's a little bit of variance depending on, if you're fixed for how much longer and what the cost of breaking the fixed rate is and whether you took a cashback deal or not initially. But it's one of these situations where you have to be proactive, and it's not going to happen unless you make it happen. But use someone with knowledge like ourselves to help you get the best rate and get the mortgage rate down.
Another good question here is the 4% savings plan it's just skipped down as another one came in. Is the 4% savings plan just for children's education, or can it be for any purpose? And is it tax-free given that you've paid tax on the income invested?
It's a really good question. So no, it's not just for children's savings, and I'm doing it for myself as an adult. And I say to people what I would do myself. So I'm happy to share with anyone my own Zurich policy document showing that I'm saving 250 euros a month into this plan for myself, because I don't like the fact that I'm not earning interest in the banks. The question in relation to, do you pay tax on it? Yes, unfortunately, you pay tax on the growth of the plan. So you don't pay tax on your contributions. So for example, the 250 a month that I'm paying into, which is 3,000 a year, let's say over 5 years, I've invested, obviously 15,000, sorry, I'm paying 3,000 a year if I was 15,000 euros, and the plan is worth 20,000. There will be tax liable on the 5,000 euros profit, but there's no way to avoid the tax man unless you're within a pension structure. But it is a very, very useful tool. And I say to people, I'd rather pay tax on profits than pay no tax on no profit.
Okay, another question is, apologies if I missed it, what fees are there for a teacher to have a financial review with you to look at switching their mortgage, changing mortgage protection, and AVCs?
We normally charge 199 euros plus VAT for financial consultations, and that includes any subsequent reviews that we do. We're looking to reach out to teachers, and obviously we're delighted to have the engagement with yourselves. Well, we're waiving the consultation fee. I suppose as the managing director of the company, I'm 48 years of age, and I'm joined by a really good team of people working with me. We want to show that we can add value, and there's no obligation for people to take our advice. So the consultation is completely free, and we can do projections for you. We can show you the benefits of your pension, of savings accounts, what you can save on insurances, and it's up to you then to make an informed decision as to whether or not you want to act on any of those.
And do you just want to maybe say just a little bit about how you engage in the meetings or the financial reviews, or what is required maybe?
So typically I email a few questions. I ask people for their names, dates of birth, salary levels. It's obviously kept very confidentially. We are regulated by the central bank. And what that does is it allows me then to start formulating information about the individual. Now, we do encrypt that information, and we use obviously password protection and so on. But what we do then is I would have a financial consultation at a day and time that suits the individual concerned, and maybe it might be in the evening, particularly if you've got a partner or you prefer to do it that way. It takes typically around 45 minutes or so, and I'd cover off the various areas that I've spoken about today. And what we then do is we provide you with a summary on the suggestions that we would make and that we would explore. So for example, on the mortgage side, as I said, the one thing that I would ask of you is to check what the cost of breaking the fixed rate is. And by getting that information, we can then work together as to the best opportunity for you in terms of, do you refix with the same bank, or do we look to move banks for you?
Great. How can you purchase AVCs?
Very simply, you can do it either through a financial advisor like us, so you have the opportunity to do that, or you can do that through the likes of Cornmarket. As I said, the differences really be that we're not tied, so we're able to offer you the opportunity of all the financial companies out there. And then it comes down to fees. So we would express what the cost would be of making those payments versus what you might be offered elsewhere.
There's another question around buying a property. So I'm hoping to buy a property for between 270,000 and 300,000. but it depends on what mortgage I can get.
Yeah, this comes up quite often. So generally, the rule of thumb is that banks will offer you 3.5 times your salary. That's the general rule. So if you're on 50,000 euros, obviously you can do the math on that. That's 175,000. Now, for teachers, because they like that type of employment, seeing it more stable, some institutions will offer you 4 times your salary. And this is why it's worthwhile speaking to a mortgage broker. You add your deposit to that, and then that is the amount that you should look to buy. Now, for a lot of us, the issue sometimes can be not getting mortgage approval, it's actually finding the property, and that can take months, as some of you may be aware. So what I say to people is you need to line your ducks up, and I think it's a twofold approach. Firstly, you try and identify a property, and secondly, you get mortgage approval. And by the time that you get your approval and find the property, that could be 3 months' time, it could be 12 months' time. The main determinants are that you're realistic about your objectives. So for example, for that individual, typically you'd need to be on a salary of about 66,000 euros a year to entertain that sort of figure. If you have a very large deposit, that may allow you to do that on a lower salary. But because the cost of borrowing is very low now, I'd actually prefer for you not to use all of your own money. So people often say to me, Nick, I've got 100,000 saved in the bank, or I got some of that from a gift. Should I use it all when I'm buying this property? And I say to them that no, typically you shouldn't, because borrowing money at 2%, even though you're going to have to earn about 3.5 to 4% as an equivalent, you can get a much better return from at least 2 of the plans I've discussed today, which is your pension and with this tax back scheme that I've referred to earlier.
Okay, I just have 2 more questions. The first one is around income protection, but I think you've kind of covered off everything on that. Do you want to add anything? It's just, is it necessary to protect my income additionally with income protection plan?
It really depends. I mean, look, it sounds great, and it's a product that financial advisors push heavily because they play on fear. I'd always say to people, you need to assess, are you the only person earning money in the household? If you are, then there's probably more of a reliance on your income. What's the state of your health? And sometimes it's a case of maybe exploring that before you get a decision, because the criteria for getting income protection is a little bit more stringent than, say, life assurance. For example, if anyone has had, say, ailments with their back, they're more likely to be allowed for that. So that may not necessarily resonate with you. There's no point you insuring for something that you're concerned about if you can't get cover for it. So the key thing then is just to find out, based on your age, based on your earnings level, what can you insure for? Get the lowest cost possible. This is why it's important to speak to an independent broker, and then apply if you're still prepared to look at this. And before you make a final decision, see what the decision comes back from the insurance company, because up until that point, there's no real decision to make.
And another good question, very topical at the moment, is it risky to invest at the minute with inflation and the Russia situation?
People have been concerned about what's happened in the Ukraine and Russia, and obviously it's a terrible situation, but markets haven't reacted very negatively towards it. Markets fell a little bit earlier in the year, primarily because of the fear of increasing interest rates. And the irony is that because of what happened in Ukraine, markets expected interest rates are not going to increase as much. So they've effectively kind of netted against each other. I go back to what I said earlier. If you are saving for 5 to 10 years or longer, don't be concerned about the here and now. The key thing is, and Warren Buffett speaks about it all the time, it's the longer that you invest for, the more that you'll make. And that is a principle. So some people who don't like risk, my advice to them is start early, genuinely, and don't try and second guess or time the market.
Another one in, does your partner's income get included in your maximum mortgage approval?
It does, and I should have mentioned, but it's 3.5 times joint income. And sometimes people say, well, okay, but I'm not going to include my partner because maybe their income is a bit more volatile, perhaps, and so on. And the thing about it is the banks would look at you. We have a really good financial budgeter, by the way, on our website. And I would encourage all of you to maybe look at our website, Alpha Wealth, and there are some really good videos. The Zurich Savings Plan is available for you to view. And we're happy to provide you with more information on it. But yes, the typically joint income 3.5 times is a general rule of thumb.
And I don't think there are any more questions. I suppose just lastly, actually, there's just one around, do you provide advice on other insurances?
Yeah, we do. And the one thing is, people often ask me what makes Alpha Wealth different. And I say to them that we provide a full suite of advice in many different product lines. I give advice on cryptocurrencies, even though we're not regulated in that area. I know from personal experience about the market, and thankfully I've had, I suppose, a few articles, written on it. So, but things like insurances, it's really important because as a financial advisor, I always look to see where I can save people money, whether it be on car insurance, house insurance, health insurance. As I mentioned, I have 4 children. I'm always looking to save money. I only ever pay for one of the children because insurance companies like Leia, like Irish Life Health and VHI offer deals for individuals. So it's really important that you look at the opportunity in any area. And if we don't provide it directly, such as health, car and house insurance, we broker that for our clients. And I haven't met a client yet that I haven't saved money for in those product lines. We just give them the information of the 1 or 2 brokers that we feel that they should use. And people ask me, why do we do that? It's because it's a good indicator of the ability that we can provide our clients.
I think just to finish up, Nick, there's been another message in just around somebody wanting to book a consultation, but their details are anonymous. So maybe you'd just like to provide what people need to do if they would like to book a consultation with you.
Yeah, probably the easiest way, and I've just put my contact details on the screen. Nick@alphawealth.ie is probably the easiest one. We will be sharing the video after this for anyone who may have missed part of it, or indeed, wants to share it with any friends or colleagues. But Nick@alphawealth.ie is probably the easiest way. My mobile number is there on the screen. And as I said, I really appreciate your time today. Obviously, it's really nice to have the engagement. We've had a lot of people show interest in the space. We will be doing further webinars. There's one on the 10th of May at 7:30 in the evening, where we're going to talk about savings and getting your savings working harder. I'm going to talk a little bit more detail around 1 or 2 of the areas that I touched on today.
Great. Well, I think that's it. So thank you very much to everybody for joining today, and have a lovely Easter and enjoy the Easter break.
Great. So I'd like to repeat that as well. Thank you very much all. It's really a pleasure.